Welcome back to Tech Tune Up. I'm your host, Paul Meeks. I'm brought to you by Benzinga Pro and all of its cool analytical tools right here on our own YouTube channel, and also with my firm, Harvest Portfolio Management, down here in the Bayou in Charleston, South Carolina. So, as you know, on this program, we're all tech all the time. I'm going to talk about some key tech stock stories and also delve into how they may have implications broader to the sector and even broader to that to the market. So, without further ado, let's get to it. Amazon, one of the big hyperscalers, spending all that money on AI infrastructure, and also, of course, one of the big names in the Mag 7. I thought this was interesting. They're getting some pushback from British regulators over their $4 billion investment in Anthropic. Now, Anthropic is a privately held company that has the AI model Claude, which they hope to successfully compete against OpenAI's ChatGPT. So what's happening with all of these hyperscalers, even beyond Amazon, is they're lining themselves up with Anthropic's Claude model or OpenAI's ChatGPT for their large language model. Interestingly enough, the only tech major that seems to be going on its own with its own open source model is Meta. And that could be really interesting if it's successful for Meta to be distinguished in that way. So anyway, I'm a little bit worried about this because obviously we don't buy Amazon for its flourishing e-commerce business as the US economy slows down and consumers spend less. We're all about Amazon Web Services, their public cloud infrastructure business, and all the things they may or may not be doing to build their AI infrastructure. So stay tuned. Shopify. Now, Shopify, speaking of Amazon, is its Canadian rival. Now, Shopify has been a dog with fleas in the markets the last year or two, but they actually had a pretty good quarter. And this is interesting to me because we're getting indications that the American consumer, at least, is slowing down spending, yet Shopify had a nice beat and raise quarter. So I'm going to keep an eye on that because I'm not only interested in potentially buying Shopify, I'm also interested as its tell for consumer spending. Next, one of the stocks that has been on Meeks' buy list successfully for some time is T-Mobile. T-Mobile didn't pay a very big fine. $60 million is not much for them, but they did have to pay a fine for some national security violations here in the States post their merger a couple of years ago with Sprint. Again, I don't think this is that big of a deal. Next on my list, here's a potential short idea, right? We're going to bet that this stock gets clobbered on the downside. So this is Carvana. Carvana is the new tech used car company. Now, I will tell you that this stock has been on a roll, trading at an all-time high, despite what one of my colleagues on Wall Street Beats, Larry Peck, thinks is financial accounting fraud. When you find a company with financial accounting fraud, particularly when its stock is expensive, and this one trades at a ludicrous 133 times next year's earnings. To put this in perspective, NVIDIA trades at only 35 times next year's earnings. This could be a powerful catalyst on the downside. So I'm going to keep my eye on it. I don't take anybody's research and just buy or sell without doing my own follow-on homework. But that is on my watch list for a potential short sell idea, Carvana. Next, I've talked about this one before, Paramount. Paramount agreed to a deal recently, and it looks like it was about ready to close. And somebody has come over the top, Edgar Bronfman. Now, I am actually worried as to why would anybody want to pay up for this bag of shit, right? In the most recent quarters, Paramount just wrote down its legacy cable business by $6 billion. So sooner or later, these people, if they succeed in buying this company, they have to have buyer's remorse. Inevitable. Next, in the same vein, is their equally impaired rival, WBD, Warner Brothers Discovery. In their most recent quarter, which was released since we last met on this program, they had a miserable quarter. Again, cable subscribers cutting the cord. That's not new, but now it is just a fire in the theater and everybody's trying to exit the only door. So anyway, just as I've told you before, if you want to play video streaming, and sometimes I think it's reasonable to do that, and sometimes I don't think it's reasonable to do that, just hold your nose and buy more Netflix. Now, here is a stock that I've been poo-pooing for some time. I really think the management is unhinged, very squirrely. But Palantir, as you may recall, is a company that essentially provides data analytics for the spies, typically government agencies. Now, I must give them some credit. And now I'm starting to rethink this company because in the latest quarter, they not only beat Wall Street estimates, but they showed a important diversification into the enterprise space. So they just don't have concentrated government contracts. They have some corporate contracts. And for this company to flourish, it has to have a more diversified book. And then I don't know what the financial impact will be over time, but they did announce a deal with Microsoft. So we'll see what happens there. Everybody knows that one of my favorite stocks is Micron, ticker symbol MU. The problem with Micron, however, is we're not going to get any confirmation of their thesis, yay or nay, until they report their quarter at the end of the month of September. So hang in there. In the meantime, my next stock, NVIDIA. NVIDIA is going to report its results on August 28th. And today is August 20th. And of course, it's going to be a major impact, not just for NVIDIA, but for the tech sector and even the US market, which is 40% propelled by the tech sector. In the meantime, I've reported this before, they are under inquiry, which I don't think will lead to anything by the Department of Justice for antitrust behavior. And also, and this is starting to subside, but there were rumors that their next-gen AI chips called the Blackwell family were going to be at least 90 days delayed due to manufacturing glitches. Now, that did hammer the stock recently, but now it's finally caught a bid and started to come back. And we'll get some clarification from the company on whether this is truly a significant manufacturing delay. But what I've always said about NVIDIA, they're so far ahead that say they have a 90-day, which is the rumor, manufacturing delay for Blackwell. What happens is they defer those revenues for 90 days. Who cares? Because in the meantime, they're not going to lose share to anybody because they're the only ones that can make the damn stuff. So anyway, NVIDIA trading at 35 times next year's earnings. You guys, I know it tripled last year and it's more than doubled this year, but still, I must admit, one of my favorite tech stocks, and I hope to get a confirmation in 8 days. Booking is a stock that I went to the sidelines on. In their most recent quarter, they actually saw a dramatic weakness in hotel room bookings. And for this particular company, that is the story. It worries me, and it worries me about all the other OTAs, which are these online travel agencies. Mercado Libre, a stock that you probably didn't hear about before you started watching this program, based in Uruguay, the South American Amazon. I've been buying this stock during the earnings season, and it's been a great trade. A great trade. Here's a company that's actually fairly mature, But in the most recent quarter, they had a 30% top line growth. And with the consumer slowing in the United States, putting Amazon's e-commerce business at risk of downsiding estimates, we got Mercado Libre upsiding estimates. So I continue to like that one very much. And two others, AMD. AMD has just announced a deal. They're spending $5 billion to buy a equipment company. When I say equipment, I'm talking about data servers called ZT Systems. But here is the interesting thing. They're going to buy this company and immediately offload the manufacturers of the servers. So this is not a threat to any of the data server companies that I cover, like Dell and HP Enterprises and even Supermicro, SMCI. What they're doing is they just want the engineers. So think about it. They are spending $5 billion for a group of AI-focused engineers. Because here's the thing. If you are going to sell AI GPUs and you want to be a second source, at least a reliable second source at AMD to NVIDIA, you just can't sell the silicon. You have to have the manufacturing wherewithal. You have to have the engineers that can lash all these things together. It is a big ecosystem. And if you don't have all the pieces of that ecosystem, you are going to be a laggard. And so that's another reason why NVIDIA is such a good investment. I actually see this as a sign with AI trying to build its own ecosystem with a very expensive purchase of engineers. I don't necessarily see that as a sign to buy AMD, even though the stock was up big on the news. I see this as a sign to just buy some more damn NVIDIA. So I think that's interesting. It really confirms the NVIDIA buy thesis. My last one here before we move on to the next section, Supermicro. Everybody knows I like this name. They did have a disappointing quarter recently released. Its gross margin was only 11.3%, and their long-term target for gross margin is 14 to 17%. Now, one of the things that's happening is they're selling so many of their servers to these major hyperscalers like Amazon, like Meta, like Microsoft, like Alphabet. And when you have customers spending tens of billions of dollars on this stuff, they're going to have pricing power, right? Your customer, a concentrated customer spending so much money, is going to have pricing power. So the good and bad is, the good is there are going to be a lot of AI servers sold. And SMCI actually has an advantage with its liquid cool servers. The bad side is when you have such big, powerful customers, they're going to squeeze you on price. So you're going to have a lower gross margin on that business despite higher sales. Nonetheless, I do think that SMCI can pull a couple of levers and get its gross margin back to 14% by the end of its next fiscal year, which will be June 30, 2025. And if they do that, this company can do $40 to $50 earnings per share. And if they do that, their stock's going up, up, up. I see the downside risk to SMCI at about 475 to 500. We actually were there a couple of weeks ago, but I actually see the upside reward going all the way back to its previous 52-week high, which was almost $1,300 a share. I like those odds. So let's move on now to my tech picks. We're back. As you know, if you've been following the program, I put it all on the table. I hold nothing back. I'm completely transparent and honest with you. Here is my tech buy list. And at Harvest Portfolio Management, see me if you want to trade this, because this is my tech portfolio that I run for a lot of customers. So in green, we have stocks that are on my fresh money buy list. In yellow, we have stocks that I like, I may hold, but I'm not buying them fresh today. And in red, we might have one that I threw in the towel and decided to sell. So take a look. I'll just talk about some changes that I've made. Microsoft, I'm in kind of wait and see mode right now. Quarter was a little squirrely. Amazon, I already mentioned some weakness in the e-commerce business, though I was satisfied in the 19% year-to-year revenue growth in Amazon Web Services. The same thing in wait and hold mode is Synopsys. Broadcom, which is going to report their quarter soon, as is Dell, one of my data server plays. They're going to report on August 28th. And I will tell you this, particularly in this really weird market we've had in the summer of 2024, if you can wait just a few days for a company to clear the air and give you their positive or negative news relative to Wall Street analyst expectations, you probably should wait. Because we've had even some companies during this quarterly reporting season, which have upsided by a good measure Wall Street analyst estimates, and their stock still goes down. Do not play with fire around quarterly earnings announcements. And we only have to wait 8 days for both Dell and NVIDIA. Netflix, I mentioned. ASM lithography is my favorite play in semiconductor capital equipment, but still the group has been under pressure. Stay away for now. Alphabet did have some flies in the ointment in their last quarterly call. Digital advertising has been growing much more briskly for Meta than for Alphabet. One of the reasons why is, as everybody knows, Alphabet's key venue for digital ads is their search ads. And when you have these search banner ads, they're typically for consumer brands. And if the US consumer is starting to slow his or her spending, then you can see the weakness in those companies. When they feel weak, they spend less on digital advertising. They're watching their nickels and dimes. And it is quite a negative look through to Alphabet. So we'll see. Arista Networks, my AI data networking play, like it. SMCI, I told you the score there. I think SMCI has a great risk reward opportunity, though I was disappointed, as I said, in their only 11.3% gross margin last quarter. But if they do just a handful of things right, not everything that's on their to-do list for the management team, this stock can do big things because their EPS could grow from $22 per share last year to $40 to $50 per share. I have started to sell my position in Hewlett Packard Enterprise. I've decided in data servers, I want to focus first and foremost my biggest position in Supermicro, which I think is a attractively priced stock. And then I'm going to give second fiddle position to Dell. Now they report on December 28th. I don't think I have the room in my portfolio playing this particularly theme with HPE, so it's off my list. Remember, I pitched a very small market cap Chinese company called Tuya, Tuya. Right now, the stock's trading at 155. In recent weeks, it had been about 10% lower to 139. This company is going to announce its results on August 26th. I will be on that call, even though it's going to be in the middle of the night because it's a Chinese company. And then I have a meeting scheduled with management immediately after, so I can take a deep dive as I do before I talk to management teams. I'm still intrigued by this Internet of Things play because the company has no debt, $1.70 per share cash, and the stock is trading at a couple of dimes less than its cash value. So I would say, given its fact that it's a Chinese stock, given the fact that it's a micro cap, consider this a lottery ticket. Do not put too much of your portfolio in the lottery ticket, right? Because it is speculative. But I own some. I hope to buy more. And for a company this small, the average daily volume is actually higher than you would think. It is not liquid, but more liquid than you would think. So, anyway, of course, when they report their results, I will be right back to you. So, the next thing is let's delve into some broader tech trends. Keep watching interest rates. As I've told you a million times, it is the most important macroeconomic variable, and it's particularly important for the valuation of technology and other aggressive growth stocks. I always take a look at the CME FedWatch tool, and the CME FedWatch tool tells us, typically fairly reliably, that on September 18th, our central bank, the Federal Reserve Board, there's a 76% chance that they are going to lower rates by 25 basis points. And there is a 26% chance, actually 76 and 24, of course, chance that they're going to lower rates even more aggressively by 50 basis points. So it looks 100% chance, and I'm comfortable with these numbers, that rates are going to be coming down, and they're going to be coming down starting September 18th, less than a month away. So I had been really worried about some of my tech stocks, right? We had an amazing tech rally earlier in the year. Then we had this beat down over the last month or two. Part of it was a simple rotation from large cap growth stocks into smaller cap value stocks. I think there was also some worries out there, which I think are unfounded, that all these folks spending tens, if not hundreds of billions of dollars on AI infrastructure will not have a return on investment once they build all that out. Anyway, that seems to have passed through the snake, and now looks like we've caught a bid, like Nvidia, for example. You know, it's always going to lead the market. Caught a bid on some of these names, so now I'm getting a little bit more aggressive on my favorite tech stocks after I hope that this cascading down, that this, it wasn't a full bear market, at least not in most names, but this correction hopefully has subsided. I talked about Venu, VENU. This is the group of online media companies that are trying to band together to do video streaming around their sports properties. I actually think it's quite interesting. It'll be remain to be seen. They're going to charge $43 per month for the service. You better like your sports to pay $43 a month on top of all the other stuff you're doing. But a competitor, Fubo, in this industry has cried foul, and a judge, at least temporarily, has put that deal on hold. So we'll see how that churns through the courts, but yeah, it's kind of a big deal. Next, you know, one of the things that's always stuck in my craw is we develop technology in the States, but the regulations are led by the European Union. I hate this. They got us by the balls, and they shouldn't. It's just a lack of leadership in our U.S. government, and it's not a Republican thing. It's not a Democratic thing. It's an everybody thing. So I continue to be wary about the financial results I'm seeing and the outlooks for what I call analog and mixed signal semiconductor chips. These are chips that go into automobiles mostly, but also other industrial applications. I've mentioned Anthropic. All of the major hyperscalers are getting by Anthropic's Claude large language model, or they're saddling up with OpenAI's ChatGPT model. Though, as I told you before, interestingly enough, out of the hyperscalers, Meta is going its own way with its own open source model. That means they share the code with everybody, and that's called Llama. And the other thing you should know among the Mag 7 is Apple, of course, has its eyes on the prize in AI too. But what they're doing is, instead of using NVIDIA's GPUs, they're actually using custom-made GPUs from Alphabet. So can you imagine if Alphabet ends up having a attractive NVIDIA-like AI GPU merchant silicon business? That could be another reason you want to own that stock. So the other things I wanted to talk about, I've hit some of these here before. On Wall Street Beats, I have a colleague, and she's super smart, and she's more of a macro analyst. Her name is Nadine Turman. And Nadine presented on our show earlier today a graph in which she's predicting that the profit margins for technology companies peaked 2 quarters ago. I do not disagree. And that's why I'm super focused on my AI infrastructure players, because I am continue to be worried about the AI infrastructure spending for some of these future AI users that is not going to be adequately monetized. It's not going to generate enough return on investment. And so, yes, if they, at the end of the day, do not get a AI revenue kicker, and they've boosted their expenses with all these AI investments without any reward, could be a problem. So, yes, you guys, I call it part one, part two. Please stick with the AI infrastructure builders. Those are your semiconductor companies. In the past, I have highlighted NVIDIA, AMD, uh, Broadcom, which is ticker symbol ABGO, and then the data server companies like SMCI, Dell, and I've now booted HPE off the curb. And of course, the data networking company to the AI stars, Arista Networks, ANET. I am not being sucked in on any of these AI 2.0 or part two plays, because I want to see monetization of their apps first. So we'll see if Nadine's right. And she's super smart. I always love to hear contrary opinions. But let's now get to some questions. I'd like to spend more time on each of these shows. A lot of questions come in. And you know what? I am perfectly cool to answer these on the fly. So please, whenever we have this program, as soon as we get in our, start firing away the questions, and I'll answer them, typically at the end of the show. First question here. Cisco Systems, has it turned the quarter? You know, I'm down here in the deep south, and I would say that dog don't hunt. Right? When you see a tech company fire 10,000 people, which they have just since February of 2024, they are in deep, deep trouble. Now, they helped themselves a bit by, even though they spent too much money on it, by the acquisition of Splunk, right, which brings in higher, kind of more software-ish margins. But the legacy business for data networking is in deep trouble. And so what I would tell you is, do not be tempted to buy Cisco even at this low price. If you want to play this, even at its elevated price and elevated valuation in data networking, particularly AI centric, I just buy more Arista Networks, ANET. So I poo-poo Cisco Systems, I poo-poo Juniper Networks, and again, I favor in that industry within tech, Arista Networks. So it looks like I've handled that question. I always appreciate your attention. If you have any follow-ups, I'm so easily found, either through Benzinga or LinkedIn. Oh, here comes another question. Oracle. Oracle, I am a little bit more bullish on than I am Cisco, which I think should be given up for a ghost. Oracle does have OCI, Oracle Cloud Infrastructure, and that is akin to Microsoft Azure or Amazon Web Services. So the AI infrastructure build, propelling those large language models, requires some horsepower. So that business, OCI over at Oracle, should continue to be the strong suit there. I am not convinced that embedding AI functions in their enterprise resource planning software, which is their core legacy business, is going to bear the fruit that investors think. So what I would do is Oracle, if I was to put it on the Meeks buy list kind of metaphor, I would have a company that's held at the yellow light. Wait and see, because this is not going to be able to work just on OCI revenue acceleration alone. You're going to have AI recreate Oracle software. I believe it when I see it. And in the meantime, I don't know if we're going to see it for at least a year or so. We just don't have enough use cases out there. The power names. Jay Rice is asking me about some of these companies that are involved in their utility companies, but they're helping provide power to AI data centers. So yeah, they're not a direct implication from the AI infrastructure bill, but maybe indirectly. But yes, we have companies like Constellation Energy and Vistra. I think they're okay. I would like them long term. I don't buy them aggressively unless they're down on dips. And if so, who takes the top spot? So the top spot, I would say I continue to prefer in that space the direct plays, my AI infrastructure building plays. And then I come back, as I told you, Robert, to the semiconductor companies, the data server companies, and my sole data networking company. I'll be back in some of those utility plays or derivative AI plays through America's insatiable demand for energy to fuel these data centers. But they're not my favorite in the group. I play those after I play my other favorites. So it looks like those are our questions. Again, so easy to find me. Just reach out anytime, man. I always am happy to write and talk to people. So anyway, that is Tech Tune Up for this particular episode. We will see you in 2 weeks. And the nice thing about getting back together in 2 weeks, we will have the very, very, very important NVIDIA quarterly report behind us. And of course, I will delve into that in the greatest detail. In the meantime, be well. We'll see you next time.